Welcome to the final episode of our 4-episode series, Lessons from the 2022 Proxy Season, part of S&C Critical Insights. In this episode, Marc Treviño and Melissa Sawyer, co-heads of S&C's Corporate Governance practice, discuss the governance proposals companies received in 2022, providing both a look back on how these proposals have changed over the last 10 years and their predictions on what changes companies may see in the future.
The 2022 proxy season marked the 10th anniversary of our annual proxy season review. For those of you who don't keep them handy the way I do, the 2012 edition was 25 pages long, 10 of which were devoted to the independent chair special meeting and consent proposals, and 1 page was devoted to environmental, social, and political proposals, noting that no such proposals passed in 2012. Fast forward to 2022, which was a record year for shareholder proposals, almost 250 more than 10 years ago. Our proxy season review is 3 times as long, with 75 pages over 2 parts. We devote only a measly average of 1 page per each of the big 3 governance proposals. You know what happened. What happened was almost all of the increase in shareholder proposals over this past decade was environmental, social, and political, as opposed to governance proposals. This year, they represent almost 2/3 of proposals submitted after reaching a majority just last year for the first time. This was driven by an almost 40% year-over-year increase in environmental proposals and an almost 20% increase in social and political proposals. It's with this background that we're going to be looking forward to next year. I think it's time to turn to the next largest category of proposals. I think that's governance.
Thanks, Marc. So as we previewed earlier, governance is not probably the most exciting category anymore, given all the activity around ESG, but we can't disregard it completely because the governance proponents have become very sophisticated about how they submit these proposals. We don't see the Staff Legal Bulletin 14L having a big impact on this category because it was fairly rare for proponents to seek no action relief for governance proposals on the basis of the ordinary business exclusion. Instead, what was more common was to seek exclusion on the basis that the proposal had already been substantially implemented by the issuer, or on the basis that there was a conflicting management proposal. And historically, some issuers were able to rely on those exclusions, even if what the company had done was slightly different than what the proponent was asking for. So just by way of example, in the world of proxy access, it had been the case in the past that if the proponent was asking for a different group limit than what the company had already implemented in their form of proxy access, it might still be possible to get that proposal excluded on the basis of substantial implementation. What we've been seeing lately is that the SEC is less likely to permit exclusion when there are distinct differences between what the proponent is asking for and what the company has already done. This played out, for example, in relation to special meeting and written consent proposals, where if the proponent was asking for a different threshold than what the company had already done, we ended up seeing scenarios where there were side-by-side votes, 1 vote on a management proposal for management's preferred threshold and 1 vote on the proponent's threshold at the same meeting. A lot of these proposals end up going to a vote because of the challenges in getting them excluded through the SEC no action process. And we kind of break down governance proposals into a couple different categories. One category are these structural proposals that encompass special meetings, written consent, and proxy access. They usually seek changes to an issuer's bylaws to implement them. The other category that we see proposals in are board composition related proposals, often looking for things like board diversity, for example, or articulating particular skill sets that are needed on the board. One thing to point out on the board composition front is that we have become aware that the SEC may be taking an interest in this category as well and asking issuers to enhance their proxy disclosures around some of these topics. So this could be something that sort of interacts with what happens in 2023 in terms of 14A proposals. There could be some intersection between what the SEC is asking for. I just want to spend a minute on special meeting thresholds because this was the largest category of structural governance proposals. We saw a flurry of proposals seeking to lower the threshold of ownership needed for shareholders to call a special meeting. And most of these proposals were seeking amendments to existing special meeting rights rather than asking for new special meeting rights at companies that didn't previously have them. The companies that were successful in having these special meeting proposals voted down were ones, for the most part, that were able to demonstrate that the requested threshold that the proponent was seeking would essentially give too much power to a single shareholder or to a couple of large holders to call special meetings that may not be in the interests of the broader shareholder base. So if you're a company that has a couple of very large shareholders, 10% or greater, and somebody's seeking a special meeting threshold to be set at 10%, one argument that appears to have been persuasive both with ISS and with large institutional holders is the argument that setting the threshold that low would allow a single shareholder to call a special meeting, whether or not other holders were supportive of that. And ISS seemed to find that argument compelling as well, as we can see from the data that shows that they recommended against some of those lower percentage thresholds in those cases.
Thank you for listening to S&C Critical Insights. For more information about S&C's coverage of the 2022 proxy season, please visit us on the web at www.solcrom.com.